Hello, everyone. So it's a couple of minutes after 1, and we're going to get started. My name is Milena Petrova, and I'm an associate professor in finance and real estate at Whitman. It's my pleasure today to welcome our panelists to discuss trends and what has happened in the commercial real estate area in the past 2 years. As you know, these past 2 years have been quite challenging in real estate, which just like in many other areas was hard hit by COVID, especially in the office and retail sectors. On the flip side, despite the pandemic's persistence, other areas in real estate have proven to be quite resilient. So no matter the case, the ups and downs in commercial real estate continue, and they present a lot of different challenges, opportunities, as well as uncertainties. So we've decided to gather this panel of experts in commercial real estate to discuss what have been the main challenges that they have confronted in these past 2 years, as well as to identify the trends going forward for 2022. So we have, by alphabetical order, in our webinar, Justin Cooper, who is a 2009 dual bachelor's in finance and accounting graduate, and also he's 2010 Master's of Science in Finance graduate from Whitman. Justin is the founder and the CEO of Layla Capital, which is a private commercial lender specialized in funding $1 to $10 million loans, mostly in the East Coast. Prior to founding Layla in 2017, Justin led the direct lending business of a family office located in New York and Miami. Before that, he worked for a New York-based distressed debt, special situations and lending fund with more than $1.7 billion of assets under management, where he managed a portfolio of more than 50 assets across the continental US. He also helped launch the fund's private lending strategy, where he built a team and grew the loan origination business from the ground up. We also have Asher Flaum. He's a 2002 graduate from the FALK College. He's also a member of the Whitman's Advisory Council. Asher is the president of Flaum Management Company, which is a leader in commercial real estate that serves as a full-service development brokerage and management firm. During his tenure, Flaum Management Company has more than doubled its property ownership portfolio. Asher currently works with Wegmans, At Home, Dollar Tree, Allegiant Assurance, and several other large nationwide companies. He's also been very active with the community and supports many community organizations within the Rochester, New York region, and was a 40 Under 40 award recipient. We have Jeff Grasso, who is a 2009 Whitman graduate with a dual accounting and finance degree. Jeff is a managing partner of Vesta Realty Partners, and he's also the board member of the James Kuhn Real Estate Center. As his capacity of managing partner, he is responsible for the overall strategy, investment activity, and management of the firm. Prior to forming Vesta in 2020, Grasso was the senior vice president, also served as head of acquisitions and investment committee member of Silverstein Properties, which is an owner-developer headquartered in New York City with holdings of more than 20 million square feet globally. In this role, he completed over $10 billion of real estate acquisitions, development, and loan originations throughout the United States, Europe, and China. We also have David Nass. David Nass is a 1991 bachelor's in marketing management graduate. David is a managing director and head of real estate finance at UBS. He is also board member of the James Kuhn Real Estate Center at Syracuse. David oversees at UBS Real Estate Finance Group, commercial real estate and mortgage finance warehouse businesses, and the commercial real estate securitized and balance sheet lending platforms, including loan origination, pricing, hedging, structuring, and distribution. A lot. Prior to his role at UBS, David was head of capital markets, real estate finance for UBS. Before that, he was a managing director at Morgan Stanley and head of the CMBS banking. Between 2001 and 2008, he was managing director and head of CMBS banking at Lehman, where he oversaw the development and distribution of more than $95 billion of fixed and floating rate securitization. And finally, we have Gregg Wallace, who is also 91 graduate from Whitman in marketing and finance. Gregg is the owner and president of AMA Financial. He's also the founder of the company. AMA Financial is a mortgage banking firm specializing in debt, equity, and mezzanine financing for commercial real estate. Gregg has more than 20 years of commercial real estate experience, which includes the structuring of over $3 billion of debt and equity financing. So welcome to our panel participants. It's a pleasure to have you here today, and thank you again for agreeing to participate. So I would like to start with David. David, could you tell us more about your perspective on what has happened in the past 2 years and what have been the main challenges in the commercial real estate business?
Absolutely, and thank you for that. And I'll just add to what you stated, right, which was, when it came to this pandemic, there probably wasn't an industry that was more negatively impacted by COVID than commercial real estate. And why do I say that? You just think about all of the asset classes and the fact that we had essentially in end of March of 2020, a full economic stop, right? It shut down completely, right? So think how that then translates into the values and cash flows of commercial real estate. And let's start with hotels, right? So hotels are asset classes that are marked daily, right? So you have no one staying at the hotel, right? So there's no revenue. You have expenses that are still in that hotel. So you have actually a negative cash flow coming from that asset class immediately, day one. The flip side is office properties, right? So think about office properties. They have long-term leases. Let's say it's a 10-year market. You have 10-year leases in place where tenants are still paying. However, there's no occupancy potentially at that property where, companies are not sending their employees in. So there's a big question mark and a lot of uncertainty around the future value of that property and the future cash flow of that property. Those are probably the two ends of the spectrum as far as, asset classes, but both materially impacted either day one by disruption in cash flow or, a lot of uncertainty around the valuation going forward. That was 2 years ago. So what's happened since then, as we've gone through various variants, whether it's Delta or Omicron, right? And where we've come back into the office and then left the office again, what's happened, in different locations across the country, it's been a very uneven recovery, uneven by location, uneven by asset class and within each asset class. So let's take those two property types again, just for a second to explore that further. There within a hotel, there's full service and there's limited service. We've seen at UBS, a significant rebound in certain limited service hotels that are kind of drive-to locations where you can stay, on the coast, enjoy good weather, get away for the weekend, and be with their family and friends. And we've seen a rebound above even 2019 levels in some of those limited service hotels. But full service hotels that rely on corporate travel, international tourism, those in primary markets, right? Let's take Manhattan and LA. those continue to really struggle, right? We don't have the international tourism that we have typically in New York. You don't see big conventions occurring in New York right now. Broadway shows are on and off, canceling all the time. So there's a lot of demand drivers that are not present today that were present pre-COVID. And the hotel and the office sector, right? Same thing. Primary office buildings in large, institutional type properties in primary markets like New York. There's still a big question mark. What are companies going to do? What are their new term? If leases are rolling, are they going to roll into what was a 10-year market? Will they maybe just extend a year or two, sign a short-term lease, determine what their needs are going forward? There's been a question mark around that. But on the suburban side, we've seen some suburban office markets really do well during this period of time, right? Because there are companies that are looking to maybe provide an option to their employees so that they don't need to stay home, right? But they can go into a suburban office, not deal with mass transit, and not have to worry about that aspect of commuting, but still feel like they have an environment where there's unity and there's team building and collaboration and all those things that are really important. One thing I'll add also, just to touch on retail quickly. Malls certainly struggled during COVID. There weren't a lot of people going to malls at that. There were anchor tenants like JCPenney and Sears that certainly struggled, filed for bankruptcy and so forth. But there were other kind of, when you think about grocery stores and drugstores, they did really well during COVID, right? And anyone who was in that shopping center probably did well too, because there was foot traffic there. And anyone that had an internet presence, they were able to leverage kind of the bricks and mortars that they had also and get through COVID. So we've seen some haves and have-nots when it comes to retail also. Industrial has been on fire since COVID started. There was always demand for it. E-commerce was always really strong. But industrial has really picked up even more so now that we are doing so much more with e-commerce. We're having our paper towels and toilet paper sent to our homes. There's no reason to necessarily buy bulk products like that at a grocery store. And you're seeing some grocery stores actually close down grocery store locations and use warehouse facilities to just kind of disintermediate that grocery store, taking the product from a warehouse to a grocery store to the customer. The customer is doing so much online right now that they can just, deliver directly from warehouse. So that gives you kind of my perspective, a little bit of, broad asset classes, the uneven recovery, what happened, in March of 2020, and kind of some of the uncertainty that we have today, even though things are recovering in many areas. So I'll stop there and hand it back to you, Milena. I think I'm mute.
Yes, thanks, David. Very interesting background. So Asher, would you mind sharing with us a little bit from your side? I know you've worked with some of the large companies that are also big regional players for us, like Whitman. So perhaps you can tell us more about that business, how they've been faring, and the trends that you see.
Absolutely, thank you. I would kind of dovetail in with what David said, and I completely agree with everything that he said. And we're a daily operator, boots on the ground real estate practitioners. So we're working with the tenants as brokers. We represent brokers and landlords, so we're working on both sides. We're landlords ourselves. We're also property managers, so we feel like we kind of have our pulse on the market on a daily basis. And what David said is totally accurate. Retail, I think, kind of would fall in between a hotel and the hotel class and the office class. There were some winners and losers in retail. Grocery stores, as David said, their sales are definitely up. I think that their product mix, and their revenue has changed a little bit. I know Wegmans in particular, they're doing a lot less prepared foods. People might notice it that are on this call. You can't really go into Wegmans and get the huge buffet and the Chinese buffet and the food to go anymore. They've really pared all that stuff back just because it's so labor intensive. The dry goods portion of the grocery store is doing well. They are doing the warehouse direct to the consumer. I do believe they are using their retail footprint for that as well. So a lot of grocery stores are, have embraced Instacart, and, the Instacart shoppers are going to the actual grocery store and buying the products and then bringing them to the consumer. So we're seeing that. We're watching the consumer closely and who that consumer is. I think that the pandemic, we talk about trends. The pandemic basically accelerated the trend of e-commerce. There was obviously a huge portion of the population that was already shopping online. The pandemic just greatly accelerated that, and it changed the customer. So now you've got, older generations of Americans that are buying their bulk, just what David said, buying their bulk paper towels and things like that online. And it's the first time that they've ever done that. So that's been a huge change in the customer demographics and how people are shopping. I'd say another trend to dovetail off David, I hate to keep bringing that up, but he was so right that, the pandemic did create large vacancies in big boxes. So what's happening to a lot of these big boxes, we've done them personally to Sam's Clubs. They are converting Sears, Sam's Clubs, other big boxes, Kmart's to industrial and fulfillment centers, whether it's e-commerce fulfillment, or we've seen a lot of medical products, medical fulfillment, basically PPE type stuff have taken over a lot of these empty big boxes. That's kind of on a big box scale. There's definitely some of the winners and losers on the restaurant side of things. Casual dining, I think, has had a challenge, as we can all imagine, and no one wants to go, or a reduced amount of customers want to go into a restaurant, unmask, however they feel comfortable, vaccinate, unvaccinate, and sit there for 2 hours and have a dinner. On the flip side of that, the QSR restaurants of the world, Chick-fil-A is expanding, rapidly. Everyone has embraced drive-throughs. So when we look for sites for QSR restaurants, even a Moe's or a Chipotle, you don't necessarily think of Chipotle or a Panera Bread wanting a drive-through, but they all want drive-throughs now. So when we're on site selections, we've got to find sites that can accommodate drive-throughs for everyone. Another strong winner, I think, in this post-pandemic world is a company that we represent, At Home, and other home goods retailers, furniture stores, Home Depot, Lowe's. I think people are traveling less with the pandemic. They're staying in their houses. They're improving their houses. They're shopping for, they're fixing renovations, furniture. So that those types of stores are seeing a huge increase.
Thank you, Asher. Turning to Jeff. Jeff, you chose 2020 to set up your company, Vesta Realty, and you moved from New York to Utah. So can you tell us more about it, and why Utah, and how is your business doing in these very interesting times?
Sure. No, I appreciate the question. So in 2020, when we want to start our own business, we're really looking for a growth market that institutional capital wanted to be in, but wasn't there in waves today. And, from an entrepreneurial advantage, wanted to have sort of higher barriers to entry with some entrepreneurial angle. So we've been, my life at Silverstein, we're spending time in Utah, started to get to know the market pretty well. And given how regional and insular the market has been historically, didn't have national or international capital flows, we thought generally the market was undervalued. So when we first came here, our thesis was high human immigration. U.S. Census Bureau 2020 ranked Utah the fastest growing state in the country from 2010 to 2020. And then we also saw a high corporate in-migration, whether it be Tesla, eBay, Microsoft, Adobe, Goldman Sachs, second largest office in the country, is actually in downtown Salt Lake, 2 blocks from my office here. And we saw this environment growing, and we were able to come in the end of 2020 and 2021 and took a positive view on the office market here. We were acquiring, we acquired about a $250 million office portfolio in the Silicon Slopes of Utah at about a 7.5% cap rate. Wafra just came into the market, Kuwaiti-backed private equity fund, and paid a 5.95 cap for one of our comp office buildings. So we felt really good at the time that this market was undervalued. There's arbitrage in the market given that these new capital flows were coming in. And we felt pretty bullish on office at the time. And that's really proved out. Rents in the Silicon Slopes of Utah are up 17% from pre-COVID. We're seeing large build-to-suit and headquarter deals getting inked as we speak. And anecdotally, even like, say one of my tenants, we bought a 125,000 square foot office building. 3 months later, that tenant had a $500 million funding round led by Sequoia out of Silicon Valley. And now that tenant needs to be 400,000 square feet, came back to us, and we're developing for them. So I think, to what David was alluding to, there's a dichotomy of office right now. The primary cities are definitely struggling. I think the secondary growth markets are flat to some green shoots picking up. But again, we also look at the big tech companies who have driven absorption in the office space, over the last decade, and have kind of made the music go on since the GFC. They're talking with their checkbooks. And I think that's kind of important here. Whether it's Google buying a $1 billion building in London last week, folks expanding in Manhattan, even though people aren't back in the office. We're taking sort of a contrarian view on that right now and picking our spots in certain markets where we think office is either undervalued or has room to grow given that human and corporate immigration. And sort of a balance for us on the commercial side is our life science initiative. We now have about 1 million square foot pipeline of ground up development and conversions in Salt Lake City to grow a life science portfolio. We've pitched 1 million square foot publicly traded tenants for new build-to-suit campuses in Salt Lake City. So we're kind of playing the commercial side from an organic growth sector, being life science, and then a more contrarian, undervalued view for traditional office located in more tech-centric submarkets.
Great, thank you, Jeff. So we also have Justin, and Justin similarly made a move from New York to Florida during the pandemic. Justin, can you share with us what promoted your move and how has COVID affected your business?
Yeah, absolutely. Can you hear me well? I just want to make sure that I didn't do a test earlier. So I guess when it all began in early 2020, like most people, we had no idea how long it was going to last and whether this was going to be. I distinctly remember having a conversation with a good friend talking about, oh, we really need to load up on food. We should go buy, $1,500 worth of groceries. And in hindsight, that would have lasted 3 weeks for the family. So, no one had any idea. And in the very beginning, the first thing to happen, especially because in our business, it's a deal-based business, things tend to happen a little more slowly, but the much more visible daily volatility that everyone was seeing in the stock market started to get pretty crazy and bottomed out in March of 2020. And REITs especially took some of the largest hits. And I know David kind of alluded to this earlier, and there were plenty of REITs, especially mall and retail REITs that were down, 80+%, and investors were all terrified, both economically and also in terms of health, not knowing how serious and how bad this is going to be. So on a personal level, having 2 young kids and having been living in New York City for 13 years at the time, we got very lucky. We moved out of the city to a house just on the water where we could kind of be by ourselves, work remotely. And that kind of prompted more of a discussion between me and my wife about, okay, where are we going next? Because just the thought of going back to New York City at the time was overwhelming, worrisome, and also just not that attractive in terms of life quality, especially, compared to living in a house versus an apartment on top of your neighbors versus not having anyone nearby. And so, we very similarly to many, many other people decided to pick up shop and relocate to South Florida. So we moved to Boca in August, or the beginning of August of 2020, along with, a million other New Yorkers. And we were kind of earlier in the trend, just, by happenstance. But even to this day, I think there's 900 people on a day on average moving to Florida. And I don't know if that's just from New York or nationwide, but it's really been unbelievable. And so in terms of the impact on business, first and foremost, we saw a lot of competition, a lot of other lenders just put their pencils down and say, we're not doing anything until we can underwrite with more certainty. The biggest question that everyone has when you're looking at a deal and you're looking at an investment in any space, in any market, is, what kind of assumptions and projections can you make, and what can you underwrite with as much certainty as possible? And all of a sudden, no one had any idea what was happening to interest rates, values, capital markets, different asset types. And so everyone was panicked, and a lot of people a lot of firms stopped lending, just because of those unknowns. And then a lot of firms were also forced to stop doing business for a while because secondary markets completely froze up. So there are a lot of lenders, especially on the smaller side and on the larger side, institutional level, that rely on other institutions and banks to deploy capital, whether they're utilizing leverage, borrowing to make new loans, or whether they're selling their loans off. And the whole secondary markets basically came to an abrupt stop in, March and April of 2020. So for us, as a smaller entrepreneurial shop, focused on loans only up to 20 million for the most part, there was a really interesting opportunity because, we're not looking at making highly levered loans, and we continued to be there for our borrowers who when they needed us the most. And we were able to do a bunch of deals in that, short period, both at extraordinarily low loan to value. So, even looking at it in the absolute worst of circumstances and looking at our downside metrics, as vacant and what could go wrong, we were at 50% of those numbers. And, with the last 12 years, as more and more capital has flooded the markets and more competitors have come into the scene, rates have been on a constant downward trajectory because of the competition, and also because rates are at a historically low relative to any time since interest rates have been around. So because of that, it allowed us to go out and put out capital at much higher rates than we typically do, which was great. And from a risk return perspective, we love that period. And then coming out of that, still in the COVID era, but end of 2020, secondary markets started to get their legs again, and we saw more and more competitors. We also saw a ton of fresh capital coming into the market, looking to buy distressed debt, looking to buy properties, looking to make loans. And so competition has started to increase, more and more, and that continues every day. But for that brief period, it was terrifying, and it was also really interesting. Not from a humanitarian perspective, it was awful. From just a purely economic perspective, it was a really interesting time, and looking at kind of everything that transpired with us, with our competitors, really is a time that I will never forget. And I think we learned a lot, and certainly can be better investors having lived through that. Happy to hit on any other topics, but I don't want to take too long. So hopefully that answered.
I should remember not to mute myself. Thank you, Justin. Very interesting again. Nice perspective also on the lending business. Gregg is also working in the same business. Gregg, like I previously said, you've had more than 20 years experience on the commercial lending side, both specializing in debt, equity, and mezzanine financing. But I would like to discuss with you your recent investment in Syracuse, in the acquisition and redevelopment and repositioning of the Skylar Hotel. Can you tell our students, which I think would be very excited to hear how this deal was set up and how, again, the pandemic has affected how the hotel has been doing in the past couple of years?
Yeah, sure. Thank you. So it's interesting. I mean, obviously we've made an investment in Syracuse, but before to get into that, as everyone's alluded here, there's been a lot of ups and downs over the last 24 months in COVID. The financial markets have been very fluid though during that. Financial markets are always quick to react. It's never as good as it is, and it's never as bad as it is. They kind of jump to both sides very quickly, and then it seems to level off as people get a handle on where things are. I have two different businesses. One is the structured finance business that definitely had a little bit of an interesting ride, as everyone alluded to. Then our other company, I have a partner, and my partner and I, back in 2013, decided to invest in hotels on college campuses. David Nass, who spoke first, alluded to how the hotel business really got hit the worst immediately during COVID. The interesting part, we went into the college hotel business because we felt that that business was a little bit agnostic to recession proof. So where things happen, i.e. no one ever thought COVID would happen, but during recessions, business travel comes down, international travel, pleasure travel, and hotels seem to get hit during those times. But yet, in our studies, college campus hotels seem to stay at a higher level than all the other hotels and continually stay flat. The way we look at it is during a recession, you still visit your child for Parents' Weekend, and you still drop them off, and you still go to your graduation and all those other events that happen on college campuses. So that's what directed us towards that business. Our business is the Scholar Hotel Group. We have 2 hotels at Penn State, 1 at West Virginia, and as Milena said, 1 at Syracuse. It was great to be able to come back to Syracuse and invest in Syracuse. I had known it's the Genesee Grand Hotel. It's actually called the Collegiate Hotel and Suites, is the brand by the Scholar, and it was great to invest. I don't know how great our timing was, but once again, we don't buy for 2 years or 3 years. We don't trade. We're holders of real estate. So we bought the old Genesee Grand. We love to go into location. Once again, that's walking distance. It's a couple feet from the Whitman School, a block or 2, great on-campus access. The building was structurally great. The inside was very tired and old, and it needed a facelift to 2020, 21 type facelift. And we were able to come in there and do that. We launched actually the new hotel after renovation on February 26, 2020. So our timing was impeccable. But I will tell you, COVID hit. And the one thing where our business plan was proven is we were at a university. COVID came, we became empty. Although the first thing we did was call Syracuse University and say, how can we help? Second thing we did was we actually ran a campaign. What we were hearing about the universities where no one was living in quad living. Everyone wanted to de-densify the dorms. There were a lot of fraternities and sororities that closed, so people had nowhere to live. There were a lot of people who were supposed to go abroad who got canceled. So we immediately basically probably leased around 80 to 90 rooms out of our 160 rooms to students. We ran a campaign right out on Instagram and did some marketing and said, come live with us for 95 days, which was the semester at that time. You get internet, parking, full service restaurant, hotel, maid service, whatever you want. And you don't need to bring anything because it's fully furnished. So we were able to adapt being at a billion-dollar university. And the same happened at Penn State, and the same happened at West Virginia, which ironically, through COVID and a pandemic, it proved our plan that the university hotel business is a lot more vibrant, stronger, agnostic to events, whether it's recession or a pandemic. And this is the first one that I've been involved in. So it was very interesting. It was definitely harder to find staff. We obviously scaled down on the expense side, but we were able to pretty much run it break even during what has really been the worst time that you would ever see in the hotel business, because we're open 365 days a year. You have to pay attention. You're always on. And all of a sudden, you never go to zero, though, in the business. Okay. You never have no rooms rented when you're 165 rooms. So, we figured out a way to be creative, and the university needed rooms for the whole month of August to have people come in and quarantine. We didn't take any people that actually had COVID. We obviously didn't want to bring COVID into our hotel, but we were able to help the students, the faculty, and the university kind of adapt to what was going on, because there was such a lack of housing and student housing and you name it. Student housing, which I finance a lot of, was actually vibrant during that time. It really didn't get hit as much as the other markets. Yes, everyone kind of left school in April, but by the time every kid spent and students spent kind of April to August at home with their parents, they were dying to get back to school, even though school was only online. They wanted to go back. They wanted to interact. They had kind of been stuck in their homes for the first 4 or 5 months of COVID. And a lot of the kids, I would say 95% of the kids came back to school, even though it was online at the beginning. And I would say we probably had 60 to 65 students living back in the hotel who loved it because their parents said, hey, let's not make a full year commitment. We're not sure what's going to go on with COVID. I don't want to get stuck in a full term year lease. Let's just do this 90 days at a time. We can leave in December and we can come back in February 1st when the next semester starts. It actually made people think of our hotel in a little bit of a different way. That's not the way we want to run our business, because that's not who we are. But hotels on college campuses, if you're on the right campus, if you're at the right location, if you have very strong ties to the university and do a lot of work with them, which we pride ourselves, being a graduate of SU, of kind of connecting ourselves to the university and being a part of that university, even though we're independently owned and we're a real estate developer and we're in business to make money. We really do like to figure out a way to give back to the communities that we've been involved with. And it's been a pleasure to actually get back to my alma mater, Syracuse, being there. And things have definitely started to pick up, having graduations and having events at the university is something that is always makes our hotel a lot busier during basketball season and football season. And it's nice to have those things back up and people coming and congregating in the hotel, because that was the biggest change that we made at the Genesee Grand, opening up the lobby. And a successful hotel is figuring out a way to people not to stay in the rooms and congregate in the lobby and the restaurant, and especially when you're a full service hotel, and feel like they can enjoy themselves. Because let's face it, when you do travel, whether it's to come see your kid, you're still only staying in a hotel room that's a couple hundred square feet. So you want to make it comfortable for the people that come into our hotel. And I think we've done a great job in the renovations. And listen, it's like anything else. Most of us developers aren't transactional where we buy and flip. At least we're not. We're a holder of real estate. So we believe that our risk is Syracuse University going out of business. So we're not going anywhere. And, there'll always be some ups and downs in our business, but we feel with a stable university and a strong university like Syracuse, it can always continue to drive us forward and accomplish our goals. So.
Great. Thank you, Greg.
Thank you.
So now that we've heard from each one of our panelists about their experience in their business, I would like to ask a question to all of you, which is looking at inflation. So as you know, last year we had the highest inflation rate in 39 years, 7%. So what do you think the impact of this rising inflation and rising interest rates would be? Looking at commercial real estate investments, as well as on the lending side?
It's a pretty interesting question because David's money got more expensive. Cap rates are driving down, so we need to underwrite growth. And I think the kind of the interesting thing on the equity markets is there's a lot of liquidity in the sector. And I don't think all that liquidity is necessarily in the system yet. And especially, maybe industrial, multifamily, things that are in love, where we've seen cap rates compress to the low threes. I mean, we've seen multifamily trades inside of threes before. So I think we're going to get to a point to deploy equity capital. You're going to have to be somewhat opportunistic. And I think we're going to move into a lower sort of return environment here on kind of real underwriting. And we'll see how that kind of shakes out. I think folks will be rewarded for actively managing a business plan, whether that's a conversion, a redevelopment, a development. But again, even moving up the risk spectrum, the manufacturer return, there's a tremendous amount of uncertainty because with inflation comes rising trade costs. To build the building is much more expensive than it was 2 years ago. We have a labor availability shortage. So even if you have a site and you have the money and you want to go do something, you might not even be able to find the right architect, the right consultants, the right general contractor who has the staff to do this. So I think we're in for what I think is an optimistic run. At least I hope so as an entrepreneur that this will pay off. But I think the folks who are, disciplined, prudent, don't get in over their skis are the ones who are going to get rewarded, because at some point I think you have to wrap your head around the music's going to stop. And again, with rates going up, and at some point growth will dilute itself when we oversupply the market. When the music stops, hopefully you have a chair.
I'll add to that, Jeff. I think those are all great points. It's also important to look back at where we were, and I'll go back to the financial crisis, right? Where we actually saw, and you're alluding to this, where, cap rates compress, rates go up. We saw an inversion. We saw cap rates actually lower than where interest rates were at that time, where everyone was being incredibly aggressive and underwriting future cash flows and, higher rents down the road and so forth, and looking at kind of, stabilized values and so forth, instead of today's values and today's cash flows. And so I think we do, as an industry, need to watch that very carefully. But I'll also say a couple things to say why we're in a much healthier place today, from a debt perspective, at least. Leverage is a lot lower than it was, during the financial crisis. Rates are still very low, right? I mean, on a historical basis, they're very attractive still. There's still a good spread between where rates are and where cap rates are. There will be that compression, but it's still a healthy spread. So, commercial real estate continues to be a good investment, both from an equity and from a lender's perspective today. So I think there's a lot to be concerned about, obviously, with inflation. I think the rate in which rates have moved up over the last month has been startling, right? And I think that causes a lot of disruption in the marketplace too. It's not just that we move, but how quickly we move and how unexpectedly we move. And I think that's caught some people offsides a little bit. But overall, generally, rates should be higher. Real interest rates are still maybe zero or just above zero. It's still a very attractive asset class, and the debt market is really healthy. So that's where I stand from a lender's perspective. Yes, things are more expensive. There is plenty of capital. There's a lot of smart equity, I think, that's in the space right now. There's a lot of capital on the sideline waiting to be deployed that was never deployed even during, the more significant disruption that COVID caused in 2020. But these are concerns and things that we need to continue to watch very carefully.
David, do you see new bond buyers showing up for your securitizations, folks saying, hey, I can't make any money in corporate fixed income. Let me go roll in the real estate because there's some yield there. And do you see any sort of supply demand imbalance on securitization products relative to the pool of liquidity out there looking to buy it?
I'm not so sure it's new investors because we've been pretty, consistent, whether it's insurance companies, money managers. That money's always been there, and the demand today is insatiable. There's not enough supply that I can create. There's not enough, bonds that I can put out there that can't be absorbed in the market today. Part of that, and let's just talk about that for 1 second. So when COVID happened, right, we still were originating loans on trophy assets in Manhattan. We just talked about all the concerns around tenancy and occupancy and what was happening there. But there is a very strong demand for bonds backed by this collateral because it's easy to underwrite. It's conservatively underwritten. The leverage is reasonable. Usually these are 60 or sub 60% loan to value. So there's a lot of demand out there for good quality collateral. Where I think, where we need to be more concerned about is when we see a lot of fast money called, typically that's hedge funds that come in and out of our market and really can move spreads. We haven't seen that post-financial crisis, frankly. It's been a very stable, consistent, demand coming from insurance companies and money managers.
I think, just on that topic, just to piggyback on everything that you guys have said, so, articulated so well, just another perspective. Look, we could probably spend an entire day or week talking about this, but just, a couple additional points. First off, just with interest rates rising, many lenders have floating rate debt. And, what ends up happening is when they're leveraging their own books, their loans then get more expensive. Additionally, there's floating rate debt throughout public companies, throughout the entire stock market. So as rates go up, all of a sudden their free cash flow goes down, and all of a sudden it also hurts valuation. So, inflation is not a good thing. I also always kind of think about the 95% of America where 30% increase in cost of groceries and gas and everything else is really hard to swallow. And, people that are living paycheck to paycheck, which is most of America, all of a sudden an extra $300 a week because of inflation makes their life unaffordable. So, additionally, just in the residential housing market, when most people look at buying a house, not $10 million plus homes, but your average person, they're looking at what is my monthly payment going to be when I add in taxes, maintenance, and mortgage costs. So, you had people be affording more expensive houses when rates are in the 2s and 3s. And then when rates go to the 4s and 5s, they're going to be either trying to buy houses in the next tier below, or prices are just going to come down, or a combination of the two. What we've also seen in the past, year and a half is home prices in many markets have gone up faster and more than ever in such a short period. Is you also have a lot of wealth creation and a lot of people that have more equity in their homes now than ever before. So a lot of consumers have capitalized on that and refinanced at lower rates, pulled money out. And, that's just one of the many factors that's led to there being more capital out there than ever before. With all the money that's been printed and added to the economy and the stimulus checks and the refinancings on homes and everything else, it's been it's going to be a fascinating case study a couple of years from now to look back on. But I just wanted to mention a few of those other factors because it's all, it all plays a part. Also just the cost of construction, right? We've had borrowers walk away from projects just because when they had initially underwritten it, there was a $10 million construction budget. And then when they got back their final bids, it was 14 million. Cost of lumber and raw materials and labor, lack of labor, all of that kind of plays a role and has increased replacement cost and also created difficulties in underwriting new projects because of that uncertainty. So a lot of different factors and kind of all.
Don't worry about it. You just underwrite higher rents, and you fix the pro forma, and you do your deal. It's all fine.
Well, guys, David and I being the young elder statesmen on this committee would say since since we've been out and doing this for over 20 some years, we've made loans at probably 2.5% or 2%. We've probably made them into the 9%. So, obviously we all know that this real estate cycle has always continued to have lots of fluctuation, inflation, lots of things drive, obviously, this business, the financial business and the real estate investment business. And, over the last 20 years, I think we've seen a lot, probably not as much as some of our clients who are in their 60s and 70s. They've probably been through, I would say, a couple more cycles than us. I kind of feel like we get to say that we've been through COVID, which I don't think any of them had ever had experienced. They just experienced lots of different either recessions and financial crises throughout their careers. And I think, like anything else, our industry is very good at adapting. I think you're talking to 5 different people here that probably wouldn't be living where they're living, doing some of the things that they weren't doing if COVID didn't hit on March 20th. And all of our lives have kind of changed to some degree, probably 50 to 60% of either how we do it, where we're doing it, and so on has changed because of COVID. And there's probably, I hate to say this, there's because of so many deaths and other things, but there are some. I always try and flip to the positives of we've learned a lot of things. I actually think through all of our recessions and through all of these issues, I think we learn about ourselves, we learn about our businesses and how to always be prepared, and that anything that can happen. And I'm a guy who always looks at the other side and doesn't look back at some of the misery that's happened, and try and take the positive out of anything that kind of comes along in our world. It makes it easier to kind of go forward. So.
Thank you, everybody. So we're towards the end of this session. So I would like to spend some time answering questions from the participants. And we have, I'm going to start actually with Jack Ryder. So Jack is asking whether you think that the shift to more hybrid work will continue to drive residential values, or has this already been priced into the market?
I think it depends on what the return to office timeline looks like. We've been out of an office environment for 2 years now. So you've seen the growth of places like Boise, Idaho, or Southern Florida, over 150,000 people moving to Phoenix out of California over the last 2 years. I think, a lot of this is driven by the tech community. I just think they're now sort of the culture and thought leaders in the corporate world right now. If we can't get back in an office over the next year or two, then I think we have some long-term trends to contend with here. But it seemed the posture sort of, third, fourth quarter of last year was, we want to have a plan to return to the office. We're putting people on alert to start making plans to be with more of a hybrid model. So I think that's kind of necessary for that to happen. But I think there's also going to be firms that are going to be virtual, and they're going to be hybrid, and they're going to sustain values in some of these, secondary, tertiary markets that have kind of propped up over time. But, I think where our head is, those markets that'll, have kind of grown over the last 18, 24 months, the ones that have jobs, people will stick. The ones that don't have jobs and are more lifestyle and leisure, I think that's where you might see a little frothiness in home values and some retraction.
Just to add to that for 1 second, I think the interest rate question is much more relevant on the residential side than it is for me on the commercial side. And I run our residential mortgage finance business that's quite large, and a lot of that is sold to Fannie and Freddie and Ginnie Mae. And I'll tell you that, we're seeing volumes down significantly from our aggregators of residential loans with the recent, interest rate movement. So, there hasn't been a lot of acquisitions of homes. There's been a lot of refinancing of loans. And I think that is going to considerably slow down, and ultimately will have, an impact on values. The demand point is clear. I think, that many people wanted to leave large primary markets, right? New York City is a great example. The suburbs have seen a great inflow of people coming from the city that didn't want to live. Not everybody goes to Florida, but I know a lot of people have gone to Florida, but a lot of people go to the suburbs around these big cities too. And that's clear. And I think that's sticky. I think people stay. But rates will have an impact on ultimate values of residential properties and the demand to move out. People will potentially, if the mortgage costs a lot more, maybe they rent and stay in the city. Maybe hybrid becomes clearer, or maybe work from office becomes a greater demand than work from home, and all those things will certainly drive residential values.
Great, thank you both. We have a few more minutes for one more question. So James Smith, Pusilico, is asking actually two questions. The first one is, what are the trends that you're seeing in commercial conversions? And the second, what forecasts are you making for real estate markets? I know the second is a very general question, but it's a good question to end with.
I think, the commercial conversion side, we've actually seen that in Manhattan for the last 20 years. Like, well, think of Wall Street. I think today, maybe there's one office building on Wall Street where we've had older, historic, obsolete office buildings be converted into multifamily. Asher hit upon earlier on the panel, big box retail going to fulfillment centers. In Salt Lake City, we have a $5 billion publicly traded life science tenant that needed space, took 100,000 square foot Dick's Big Box and turned it into a life science headquarters. I think, the stuff that's out of favor is trying to find a home, but the challenge now is just a basis play. And how do you actually take that space, convert it, and create quality space? And I think it's got to be, assets that are out of love in their current sector that are sort of primed for conversion. And for a forecast, I'm just kind of resting my hat on, I think there's more capital in this sector than there ever has been before. I think you're seeing a rollover from different asset types into real estate, whether it be people are looking for yield. And I think there are still certain sectors within real estate right now that are sort of undervalued, and you have to take a little bit of a view on it right now. And we haven't seen the compression across the board like we have in multifamily and industrial of what's in love. So I'm just a big believer in, if you can find quality real estate, you can underwrite it with prudent leverage and a realistic business plan, it's a good opportunity to be bullish.
Great, thanks, Jeff. Anyone else to help with the predictions?
I think Jeff hit it on the nose. It's if you've looked at it, real estate, whether it was office then converted to multifamily, or shopping centers converted to distribution centers, bricks and sticks in certain locations in certain markets, you continue to get creative. We fulfill the needs and the demand. Real estate fulfills the needs and the demands that you see, that kind of, as our world changes from technology and everything going online or whatever it is. If you notice, real estate figures out a way to kind of convert its space or land for those types of needs and those types of users, whether it's manufacturing, distribution, you name it. Manufacturing went off seas, and then 20 years ago, everyone started to use those facilities as something else, and now it's starting to come back in the US a little bit, because the one thing that COVID did is it basically, there's a lot of people who say, I don't care how much cheaper it is overseas, with what they did to my business and not shipping me and not being able to get product here. Okay, I would rather manufacture here in the US, or I want to figure out how to open my own plant. There's a lot of hospitals that we know that started to invest in manufacture PPE and wanting to do it domestically, and investing in companies and warehouses down here and production plants to do that, because they said, we can never be in a situation like we were. We relied too much on the international product, and real estate adapts to those things consistently over and over, year after year.
Okay, thank you. Well, we're out of time. and I think it's a good time to stop. Again, I would like to thank to our panelists for coming today and spending time with us to discuss the impact of the pandemic on commercial real estate, as well as on residential, as well as to give their views in terms of what lies ahead. So thank you everyone for coming in. Have a great weekend and all the best.